All right, let's dive right into this explainer. Today, we're unpacking a massive continent wide shift. We're talking about a complete 180 from the old heavy debt spending model towards something everyone's been eagerly anticipating, a private capital driven infrastructure model. Basically, we're going to look at exactly why every African country is racing to build what we call a national infrastructure pipeline. But before we get lost in the billions of dollars and, abstract financial funds, let's just ground ourselves for a second. We're talking about the physical stuff, the roads, the power grids, the digital networks, and the water systems. These are literally the lifeblood of economic growth. I mean, without these physical arteries, economies just can't function. Trade gets totally stifled, and all that amazing potential, it just remains locked away. And the stakes here are absolutely massive. The African Development Bank estimates that if we can close this infrastructure gap, it could boost the continent's GDP growth by a full 2 percentage points every single year. That's a staggering amount of wealth creation and poverty reduction waiting to be unleashed. It's literally the difference between economic stagnation and leapfrogging those outdated systems straight into a brand new era of digital and physical connectivity. So here's our roadmap for this explainer. We'll start with Africa's infrastructure financing gap, then look at the public debt problem, and enter the infrastructure fund. After that, we'll hit monetizing assets for seed capital, weigh the successes, risks, and returns, and finally look at building a Pan-African pipeline. Section 1. Africa's infrastructure financing gap, or, as I like to call it, the trillion-dollar bottleneck. Now, check out this sheer imbalance. Historically, a staggering 95% of Africa's infrastructure funding comes straight out of the public sector's pocket. The private sector is chipping in just 5%. To put that into perspective for you, in other developing countries around the world, the private sector typically contributes closer to 17%. So Africa is leaning almost entirely on government shoulders to build the whole shebang, from mega dams all the way to cross-border highways. But here's the kicker. This burden is completely suffocating growth. Why? Well, Africa holds the lowest tax to GDP ratio globally, just 16%. It's kind of like trying to fill a giant swimming pool using a leaky bucket. Advanced economies usually sit somewhere around 34%. So this perfectly illustrates why relying on tax revenue is just broken. Governments simply aren't collecting enough taxes to fund the billions needed every year. Take Kenya, for example. They need $12 billion annually just to hit their 2040 development goals. Which brings us to Section 2, the public debt problem, better known as the debt trap. So if there's no tax money, how on earth have governments been paying for all these massive construction projects over the last decade? The short answer? Debt. They've relied super heavily on loans from global lenders, places like China, the IMF, and the World Bank. And sure, that built some much-needed roads and railways, but it has pushed these countries right to the breaking point. Kenya, for instance, is now grappling with one of the highest debt service to revenue ratios in Africa. Basically, a huge chunk of government income goes right back out the door just to pay interest on old loans. Your fiscal space shrinks, and you literally can't afford to borrow another dime to build the next road. And that brings us to Section 3. Enter the infrastructure fund, the pipeline pivot. This is our aha moment. The absolutely crucial point here is this transition. We've got to stop looking at a road or a power grid as just a government expense that drains taxes and piles on loans. Instead, governments are shifting to an infrastructure fund model. This means they set up a corporate, limited liability entity that acts just like a private investment fund. It uses equity and commercial agreements to actively attract or crowd in private capital. It's a real game changer. You transform a public works project from a huge government headache into a highly attractive corporate investment asset. If we look at Kenya's new National Infrastructure Fund as an example, you can see exactly how they build this financial pipeline. Step 1. The government drops in the initial seed capital to absorb those early risks. Step 2. The fund uses that anchor money to pull in massive private capital from domestic pension funds and global investors. Get this, Kenya actually expects every single shilling they invest to pull in up to 10 additional shillings from the private side. And step 3, that multiplied capital is deployed into revenue-generating projects, like toll roads or energy grids, which then generate the cash to pay investors back. Moving right along to Section 4, monetizing assets for seed capital, the privatization play. But here is the billion-dollar question, right? Where does a completely cash-strapped, indebted government find that massive initial seed money without just taking out more loans? Well, they do it through strategic privatization. Under Kenya's ambitious plan to mobilize 5 trillion shillings over 10 years, they are unlocking that initial cash by monetizing mature state assets. For instance, they sold a 15% stake in the mega profitable telecom giant Safaricom to Vodacom for a whopping $1.6 billion. They're also planning a huge IPO to sell 65% of the Kenya Pipeline Company, targeting 100 billion shillings, plus selling off shares in state cement companies. And the catch? By law, these proceeds are strictly ring-fenced. They cannot be blown on everyday government salaries. They have to go straight into the infrastructure fund. Section 5. Successes, Risks, and Returns. Time for evaluating the shift. Naturally, mixing private markets with public works stirs up some serious economic debate, and we need to look at both sides objectively. On one hand, you have very valid economic concerns. Take economist Kwame Owino from the Institute of Economic Affairs in Kenya. He points out the severe opportunity costs here. His argument is that when a government's fiscal space is already super constrained by debt, taking the cash from asset sales and risking it in a new corporate fund is a really dangerous move. He thinks governments in that kind of debt trap should only focus on the absolute essentials, what economists call non-rival, non-excludable infrastructure, instead of taking corporate bets that might just blow up and become a public burden later. On the flip side, though, we can look at where this is already working brilliantly. Take Nigeria's InfraCredit as a prime example of the upside. InfraCredit is this specialized company that provides AAA-rated credit guarantees. Think of it as a gold standard insurance policy for local currency bonds. Now, why does that matter? Well, African institutional investors, like pension funds, are sitting on nearly $1.85 trillion in savings. But historically, they wouldn't touch infrastructure because it just looked too risky. By offering that rock-solid guarantee, InfraCredit is successfully funneling those massive domestic pension funds directly into sustainable infrastructure, like renewable energy and telecom, all without adding a single cent to the national debt. Finally, Section 6, Building a Pan-African Pipeline. Let's look at the continental realities. Let's zoom out for a second and look at the whole map, because this isn't just happening in one or two places. It's a structural shift across the entire continent, and we're seeing real results on the ground. Down in South Africa, the government rolled out a 100 billion rand infrastructure fund to unlock private investment for non-toll roads and vital water supply projects, including the Lesotho Highlands Water Project, which is huge for increasing the water yield for their economic hub. Meanwhile, in Nigeria, the Presidential Infrastructure Development Fund has actually delivered on massive projects like the Abuja Canoe Road and the Second Niger Bridge, carving out entirely new commercial corridors. So this Pan-African movement is actively using these innovative capital pipelines right now to bypass the old constraints of public debt. As we wrap up this explainer, I want to leave you with a provocative thought to chew on. We've looked at the massive financing gap, the absolutely crippling nature of public debt, and this ambitious but definitely risky pivot toward corporate-style national infrastructure pipelines. The blueprint is clearly there, and trillions in domestic capital are just waiting to be deployed. But as always, execution is the whole ballgame. As these nations try to pull off this massive shift from a debt-driven era into an investment-led future, the ultimate question remains, will private capital actually be the golden key that bridges Africa's infrastructure gap, or is the continent just trading a public debt trap for private one? Thanks so much for joining me today to unpack it all.